Joining me now is Cole Smead, CEO and Portfolio Manager of Smead Capital Management. Always appreciate a good Barbie reference, Cole. Welcome.
Thank you. Good to be here with you, Kelly.
So, this is the biggest debate. I mean, literally like a $20 trillion debate on how big the number is. Do interest rates stay up here or not? And you guys are firmly in the camp of they will. And walk us through why you think that is and what it would really mean.
Yeah, it's a great question, Kelly. And I'm also having the blessing of coming to you guys from Ridgeline's base camp here. This is Dave Duffield of Workday's, third iteration in his successful career. And so it's good to be here. Let's just put it this way, Kelly. I'm 39 years old. In my working career, there's really only one other instance of short-term interest rates sitting at this level, which was back in 2007, before things fell apart. And so we look at this as we've had a 500+ basis point rate rise on the short end of the curve. And in effect, the long end of the curve is saying, we're not going to have to deal with any inflation going forward. If you look at the TIPS market, it's yielding 2%. AAA corporate bond yields are sitting at 5%. So people have priced in 3% inflation. Anything worse than that in inflationary terms is very tough for stocks. If you go back and look at the valuations, looking back to the high of 21, we really haven't greatly changed stock valuations relative to interest rates. And again, Barbie didn't want to live in fantasy land either. I just think there's way too many Kens out there that think they're going to be just fine.
You have a lot of picks in the energy space. That's no accident. I'm sure you're looking around, and obviously we've talked with Bill about the home builders. I mean, actually, this would be a good juncture to ask if you're kind of pulling in the horns on that, although I suspect I know the answer. So what are the areas, parts of the stock market that you do think can kind of hold up here?
Yeah, for how poor it is for the broad indices, to your point, we're not saying all stocks have to do poorly. That's not the big idea. The big idea is it's the composition of the S&P 500. So to your point, I'll give you a couple other instances where we had this. It was called the 1970s. Real returns for stocks were very poor. You lost real money then. And then the 2000s. And interestingly, going back to those two prior eras, despite the fact the S&P lost real money, investors got fabulously wealthy in the energy business. I believe we're probably the most bullish people on energy equities out there in the stock picking world. Yeah. And yet at the same time, we're bringing people up to speed about how excited they should be, how high the returns on capital are, how good the capital allocation is. And I mean, you can find return on equity as good as technology companies out there in the stock market in the energy business, but because it's asset intensive or it's not asset light, they're unwilling to even look at it.
So I hear you, and you guys were ahead of Berkshire on Oxy and on a lot of other things going on in the energy space. But I look at it and say, well, but from a 30,000 foot point of view, the world is moving away from fossil fuels. And so are these stocks ever going to command, a price that respects the return power that they have? I know it sounds ludicrous to ask, but it's like, will their going away, their extinction, sort of, just handicap what people can get here? Or if they try to keep up and diversify into the other businesses, then they get crappier results.
Yeah, humans solve the problems that they want to solve ultimately. So let's just theorize that we've decided that carbon's a bad thing. Well, we'll solve carbon. That's the history of human ingenuity. And that will never change as long as humans are on this planet. So I point that out because now the question would be, if we solve carbon, who benefits the most? The irony to that answer is it will keep carbon businesses in business for a longer tail than people ever thought. So that's, I think, as you look at carbon capture and all these other forms, you could see a shorter tail if we don't solve carbon, not because there's not demand. Demand continues to grow. Even in coal. I mean, coal is not oil, but yet demand is growing in Asia and Africa. It's not growing in Western culture.
No, and Peabody has been a good example of a stock that was left for dead and not in the time
but there's no market cap there, Kelly. That's the irony. It's like the big institutional players, the big mutual fund companies, they're trapped out of this. I just look at this as it's a great small investor opportunity, or firms that have the ability to move capital around like we do. What a blessing for our investors. And most of the investable world's completely trapped out of this. Thank God.
It's a really interesting point that now makes me think back to Philip Morris and again what that stock did for investors for a very long time after the big settlement in the 90s. Okay, quick final question on Lennar, just because it just had, if I'm not mistaken, had a tough reaction to earnings. This is still a name that screens very highly for you guys. Homebuilder confidence is now starting to kind of pivot and reverse. Do you stick with it here?
Follow Stuart Miller. Okay, he's letting the street know we are going to continue to build even to the detriment of short-term margins,
Right.
because the need is so large. They're playing the long game, and all the Wall Street analysts are focused on what's going to happen in the next 6 months. They're being foolish. Follow Stuart Miller. He's a brilliant capital allocator in the space, and he's many billions richer than the people that are criticizing it.